You're listening to The Intellectual Investor, episode number 32, How a Stock Market Turns Investors into Gamblers. Written by Vitaliy and read by Elliot. To read this article online, or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. How a Stock Market Turns Investors into Gamblers. Don't let this wave of stock market volatility go to your head. The value of the company in your portfolio doesn't change by a positive or negative 5% 3 times a day. Get the value right, and the price will follow. For example, my firm recently met with a prospective client, a physicist who has made millions of dollars by owning apartment buildings in the US and Canada. He confessed that he never was able to make much money in stocks. As we talked to him, we observed why. The Dow was having one of those 500 points up, 500 points down days. He was visibly happier when the Dow was going up and sadder as it was going down. People who are otherwise successful as businessmen and as investors in private businesses or real estate change their behavior completely when they enter the stock market. I have a friend whose father has made hundreds of millions of dollars by building several companies from scratch in Mexico. An absolutely brilliant businessman, and the worst stock investor ever. He'd fret about every move in his stock portfolio. As we talked to the physicist, we used this analogy. What we, or any rational investor, do is not much different from buying an apartment building. First, you look at the quality. How well is the building built? The location and demographic trends in the area, and so on. Then you start valuing this building. You formulate your best case and worst case scenarios for rents, occupancy, property taxes, and other important variables. Price to square foot, price per bedroom, price to worst case rent. In the stock market, these shortcuts are price to earnings, price to cash flows, and price to book value. If the price of the apartment building is at or below your worst case scenario, you buy the building. If not, you move on. This is a rational, business-like way of valuing an apartment building or any asset, including a publicly traded one. Yet, there are 2 important differences between an apartment building or any private business and a publicly traded company. The latter offers instant liquidity and low transaction costs. These differences should be huge advantages. To sell an apartment building may take months or years. Transaction costs are enormous. 3% to 7% of the building's value to buy or to sell. In and out costs combined could be as high as 6% to 14%. The stock market should be a paradise for an apartment investor or businessman. Instead of having to deal with tenants and local authorities, you can buy stocks or even an apartment REIT, that is real estate investment trust, that owns hundreds of apartment buildings, arguably reducing the risk of owning a single building. The REIT is run by professional management. In this case, the definition of professional is that they get paid. You can let them deal with tenants. Of course, you have to analyze the REIT's management to make sure that they are competent and properly incentivized. But this analysis is not much different from what a business person would do when hiring the manager of an apartment building. So, you can do the same analysis you performed on an individual apartment building on a REIT, except, and here is where we enter into the domain of public equities, and the rational person is replaced by an irrational one. Stocks are priced every second of the trading day. Thousands of times a day, someone tells you, this company is worth this much. Actually, this is not what they tell you. This is what you hear. What they tell you is, I would buy or sell this company for this much at this moment. There are a million reasons why someone might want to buy or sell a stock on a given day. A lot of them have nothing to do with the company's value. So yes, there is a difference between value and price. You only know the difference if you spent the time to value the company. If your apartment building was a public stock, its price would fluctuate daily, and most of the fluctuation would just be noise. The price would be moving based off local weather, employment, highway traffic, a mayoral race. The list is long. All of these factors will be transient and random in nature. In a word, noise. If a building similar to yours is put on the market at a ridiculously low price by a forced seller, you are not going to be upset that your building is now probably worth less. You'll see it as an opportunity to buy another building on the cheap. That is rational, business-like behavior. The liquidity of the stock market and its negligible transaction costs are great features, but probably do most people more harm than good. They can turn even most otherwise astute private investors into degenerate gamblers on a daily basis. The difference between a gambler and a degenerate gambler: the gambler plays with as much money as he can afford to lose. The degenerate gambler puts everything on the line. When you gamble in the stock market with all of your life savings, you are a degenerate gambler. This is why it's important for us to focus on what businesses are worth, not how the market prices them. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.